Good morning, everybody, and welcome to Saxo's Global Market Call. It is Wednesday, the 6th of December, and we start with a comment on FX from John Hardy.
Thanks, Christopher. Quite a change of pace for the markets and a bit of pickup in volatility here. We're seeing the yen, Japanese yen, quite a bit stronger overnight. This general risk off. We're seeing bond yields going down despite the U.S. tax reform progress. Without U.S. Treasuries getting any sort of more traction on higher yields, we're seeing a stronger yen across the board, and especially ugly section in risk appetite in Asia. Some general worries on Asian growth. Maybe this signal from the copper market. Take it as you will, that this big down day in copper. Ole, I'm sure we'll talk about that. But for the Aussie, we saw quite a whiplash setup over the last couple of sessions. You saw a reasonable rally in Aussie and a pretty solid rally in Australian rates on a number of positive events yesterday, and then these are all wiped away overnight with the big correction in copper, which is sort of a proxy for the whole industrial metals complex. All the big mining stocks in Australia down heavily, and then a GDP print that missed a bit for Q3. So Aussie suddenly goes from being a one-day star, and maybe showing signs of consolidating higher versus the dollar we discussed yesterday, to being a dog. And we see the chart here of Aussie yen. A pretty nice technical turnaround right at this whole 86 area, which was a prior low, reversing there and at the 200-day moving average. So I think the bears are firmly in control here, and we'll be looking lower for Aussie if this set of circumstances continues. For the dollar, we saw it. We've seen it kind of sideways if you look at it broadly. You've got a weakening ISM manufacturing, but it's still a very high number at 57.4. Again, a bit disappointed we're not seeing a bigger takeaway from the tax package. And then on the Swedish krona, it was up sharply yesterday on Ingves, saying he didn't know why the Swedish krona was weakening, but the Riksbank certainly is not pursuing a policy of devaluation. So a decent one-off rally there. Big event risk of the day is the Bank of Canada for the Canadian dollar. We've got a really big and important support area here in the 126.65 to 126 area. This big sell-off was on that very stellar jobs report. Some of the other data previously from Canada, not surprising so much to the upside, so we need to see almost an overtly hawkish Bank of Canada, I think, to get a major move down here. I'm not seeing it, but let's see what they say. I think it's likely we're going to see a pretty boring statement today. Otherwise, ADP employment change data, the market never knows what to do with that. I'm not sure the focus is so much on U.S. data anyway, and employment data is notoriously lagging, but that is the focus through the end of the week for U.S. data. Otherwise, it is the Bank of Canada decision that will keep occupied traders focused today. And then we have, of course, next week, all the big stuff, FOMC meeting, ECB meeting, that EU summit, of course, the whole Brexit issue, still stuck in neutral. And then the week after, finishing off the year for macro, I would say, is the Riksbank and BOJ meetings, either of which is going to prove, actually, those are probably the two most important meetings for their respective currencies, potentially. That is it for me, and I will leave you over to Peter on equities.
Thank you, John. So the big story we have in the market right now is the continuous sell-off in Chinese equities, evidenced by the Hang Seng indexes, which you can see here to the right. We've broken down below that 29,600 level that I mentioned in the house view, and then we broke down a couple of sessions ago through that long-term trend line, and we're now trying to find support just above that 28,000 level. There are a lot of nervousness in the market over demand. At least that's some of the stories that are flourishing around. Also with this story going on in copper, which had its steepest decline and worst decline, in multiple years. But we'll talk more about that. I don't think demand picture is the whole story here. I think there's a lot of technicalities as well. Year-end ending flows. Because if you look at the leading indicators in China, they actually turned around a couple of months ago. The numbers coming out of Australia also supporting that demand is not falling dramatically here. So it cannot be the full story, but it's definitely something that we are monitoring. In the U.S. yesterday, we had a very interesting session because the only sector that was up was actually information technology. So tech stocks were a bit. All other things were down, specifically the capital-intensive sectors like utilities, telecommunication, etc., which was pretty odd that because we didn't have any move in the yield curve or interest rates in the U.S. So it's a very odd behavior. But if you look through the underlying flows, it looks like what's going on is a very sharp flow out of momentum stocks and into value stocks. That seems to be the most credible thing that can explain the big moves that we have seen in the US market lately. That's typically something that is temporary. It's just a style shift, by big institutional investors with a big quant overlay. So it's just something that we should put that much emphasis on at the time being. Looking at another industry, yesterday we had information coming from IATA that's seeing the airline industry's profits going up with 11% next year. So a lot of demand still in the system for airliners. Momentum is still strong. I looked into our quant model this morning, and the top 3 picks in our quant model is Qantas out of Australia, IAG, which is British Airways out of London, and then we have Lufthansa. Lufthansa has been one of the most phenomenal momentum stocks in European equity market, going from around below 10 to almost 30 in euro terms. Also here in pre-market Europe, I haven't put it on my slides, but we have a company called Steinhoff International, which is the second largest global furniture group after IKEA. Very big growth, very high growth rates in Africa. That's their key primary market, so definitely focus on emerging markets. The CEO is stepping down because of accounting irregularities. There will be a probe into what's going on. And we're seeing the stock is down in Johannesburg pre-market by around 50 to 60%. Its primary listing is actually in Frankfurt, so when the extra exchange is opening here in 10 minutes time, we'll see what happens. But there will be a lot of investors heading for the exit. So watch Steinhoff International. Later today we will have still robust the US job growth from ADP. It's 13:15 GMT, 190k expected, a little bit down from October, but still very strong numbers. And then interesting for those that are watching Tesla and the whole EV space, we're seeing a pretty big cobalt disruption right now in Congo, with mines being shut down. The government is trying to shift the partnership in some of the key mines to other partners. There's a big legal dispute now going on in the international courts, and that's actually making a supply disruption here that could hurt the EV space. So that's actually an interesting story to follow. And with that, I'll give the word to Ole on commodities. Thank you.
Thank you very much, Peter. And yes, let's start off with the copper story, because as you can see on the chart over here, we had a bit of a dump yesterday. We broke below 305, which has been highlighting as a level of support, and we saw accelerated selling, only to be met by some support where we're hovering this morning around the 296 area. It's interesting to see that since the rally started, the latest rally started during May, we've had only 2 corrections. We had the one here just before the fourth quarter, now the most recent one here, and both of these have so far have managed to find support after a 38.2% correction, basically meaning that so far these have been weak corrections within an uptrend. But obviously it's going to be interesting to follow copper now over the coming days to see if there's any further additional weakness to be seen. The drop yesterday was, as mentioned, the biggest in almost 3 years. Technical selling, as I mentioned, but also this the continued story that has been emerging about worries about Chinese demand heading into 2018. We do have the industrial lull for winter demand here over the coming months, which is not helping. And but the big story is really if Chinese demand is going to suffer as the government reins back on spending going into 2018. There's also been some stories about the recent Shanghai Metal Week, Copper Week in Shanghai, which is normally a time where producers and consumers they agree on smelter prices for the coming year. They failed really to reach any consensus there. It could indicate that there's not. It has been taken as a sign that the demand may not be as strong as expected. So the end users are bulking and paying too high a cost for refining the metal at this stage. So that's an interesting one to follow over the coming days. Another one that metal that were gone under pressure yesterday was gold. But I think if you look at the performance in copper and silver, gold is more a follower than a leader during this weakness. We have seen since yesterday, both as John mentioned, yen has recovered somewhat. Bonds are trading a tad higher. Real yields have actually moved a bit lower as well, and we're seeing the stock market weakness. And I think what we have here is just continued some long liquidation after investors got too excited last week when we tried to break 1300. We need to find support here down towards the 1261 area. It's the October 6 low. But at the same time, we're also seeing ETP holdings continue to climb. We are sitting close to a 4.5-year high there. So even though we've seen some gold weakness recently, there has been buyers emerging both in ETPs but also in futures. And the futures are the one that's been left most vulnerable and are currently being reduced. And also just seeing that the open interest on COMEX gold has continued to fall over the past few weeks. It does indicate the market there's not any strong appetite. Not for long, but also not for shorting the market at this stage. And so on that basis, we're not overly bearish on gold, even though we've seen this weakness over the past few days here. Oil is drifting lower towards support, which is still the last week's lows, 56.75 and on WTI and 62 on Brent. The API last night showed quite a big. The headline stock draw in oil was bigger than expected. Bigger than the EIA survey expectations, but what nerved the market was the gasoline and distillate stock rise, which basically means that yes, refineries are producing at high rates, but the end demand is not there. That means it's going from one barrel to another, and if these numbers are confirmed this afternoon, that could add some additional downside weakness to the oil market. OPEC is with OPEC out of the way, the market will be focusing primarily on US producers and also the near 1 billion barrels that's already held by speculators. And that just leads me to the final slide here, because we are into December and we are also into time of year where investors are more thinking about reducing exposure than adding exposure, and that basically means just taking a look at the COT table, which I produce every Monday. This is basically over here. We got the relative position relative to the 1-year high. And you can see some of the positions which are where we got some risk of long liquidation or short covering as well. But it goes both ways. And obviously the oil market is very extended to the upside. And the grain sector, we have something like corn and wheat extended to the downside. And just taking a look at copper, we have the long there. We have the net long there at 65% of the recent high, which was a record. So again, just a gauge for where we potentially could see some changes in the prices. Not necessarily because we have a major change in fundamentals, but because there's a risk of some risk off ahead of the year end and the quiet time of year. I've spoken far too long. I'll pass you back. No, we got fixed income as well. Sorry.
Thank you, Ole. So in bond markets, we saw a positive day yesterday, and this is followed up today also with a small rally due to the risk off we see in equities. European government bonds, we start bunds up like 50 cents or so, and with yields just below 0.30 again. So new not record lows, but new lower lows for the European government bonds. Also, on a positive note, Greece is below 5% for the first time since 2009. That is the deal agreement with the international creditors that was reached in the weekend. So we also see quite a rally in the Greek government bonds. Looking to LATAM, yesterday we saw an explosion of new issuances. The area for most of them are like 6 to 7% in dollars, and we did see names like Tech Petrol, GOL, Itaú Unibanco, Minerva, and province of La Rioja from Argentina, just to mention some of them. So why is this happening now? I see it as like a window for opportunity for the issuers due to the fact that the yields right now are quite good, seen from their side, and also they are very well received. There's still plenty of cash to find a home before we close books up to Christmas. So also right now there are discussions in the market regarding emerging market bonds, because they have seen a magnificent rally also this year, and as we can see on the graph here, we are still on very high highs again. So some of the discussions are regarding when will this rally stop, and do we see a spike and a sudden fall in the market? And some market participants believe that we will see like we will exceed the 07 top by more than 20%. So still some room to go for the equities, and also we can guess that positive development will hit bonds as well. Again, this is all about plenty of cash in the system, and is also very much related to the dollar, and still a lot of QE in the system. Going to our weekly bond update, I think we have an interesting story on yield curves. LT have made a nice piece there to look at the yield curve. Right now we have a very flat yield curve, 210 here, close to 50 basis point. And what do that exactly tell us? Well, one thing for sure, there are expectations of an upcoming Fed hike very soon. So not much to report on the short end, but the long end are very split here. And we do see two camps. One is the recession camp that believes the Fed is like bluffing. They will come with a hike and then they will more or less stop hiking due to the fact that the economy might already de-accelerate, break a bit, and inflation will not be seen. That's the recession camp. And the other camp is more that what we see in the long end right now is again plenty of cash, excessive stimulus, and the moment we see especially ECB starting to get some tapering on their QE, we will see longer ending in US and Europe starts spiking in yields. So these are the two camps, and it's a quite fierce discussion in the markets right now. Everyone looks out for signs of inflations. So I think inflation will be one of the big triggers when we enter Q1. That's it from Bond Risk. Thank you.
Thank you very much, everybody. Just to sum up the main events for today in Europe or European time zone, Germany's October factory orders is the main report of note, and it should be very solid in light of recent PMI readings. In the US, most interest will center on the ADP employment report, but we could also see some positive revisions to Q3 productivity growth. Finally, we have in Canada, the BOC is likely to announce a stable policy rate of 1%, but there will be plenty of interest in the statement and what it implies for 2018, given the very strong employment report we saw last Friday. And with that being said, we wish you a nice day, and we will be back tomorrow at 8:40 CET.